Good afternoon, everyone. This is Anthony Alaka with Torrey Hills Capital, and welcome to the Millennial Precious Metals webcast for October 4th, 2022. Hope everyone's doing well, and thanks for taking the time today to join our virtual lunch. Many of you are already familiar with Millennial Precious Metals, having been introduced to the company about 10 months ago. A lot has happened in that time, and we're happy to have management on today to discuss what's happened, give us a brief overview of the company, a refresher, if you will, and talk about developments and the outlook for 2023 and beyond. Just to refresh your memory, Millennial Precious Metals is a Nevada-based exploration company with 7 properties in Nevada and 1 in Arizona. The company has been engaged in an aggressive drill program at its key assets with a PEA expected early next year. We feel that the company is well positioned to be a multi-million ounce producer. Millennial trades on the OTC market under the ticker MLPMF and on the TSX Venture under the ticker MPM. It's currently trading with a market cap of only $30 million US. The company has a very strong balance sheet, high percentage of institutional ownership, a lot of insider buying, and is trading at a discount to its peers, as you'll see in the presentation. So we feel that there's plenty of upside as the company continues to execute its strategy. And as I was discussing with Jason earlier, even though gold prices pulled back a little bit, they recovered nicely, but we feel that the current outlook for higher inflation bodes well for gold prices over the long haul, and Millennial Precious Metals is well positioned to benefit from the positive outlook in the space. And now is really the time to consider adding precious metal stocks to your portfolio, especially at these levels. So with us today to discuss Millennial Precious Metals operations, growth strategy, going forward is the company's president and CEO, Jason Kosec, and the company's VP of Corporate Development, Jason Banducci. It's great to have you both on today, and thanks for taking the time to give us an update on the company. Obviously, a lot of exciting things are happening, and I'm excited for you to share those with the group. Everybody knows the format. If you have a question during the presentation, simply type your question into the Q&A box, and we will make sure that it gets answered. So with that, I'm going to turn it over to Jason Kosec, who's going to take us through the deck and explain everything that's happening with the company and what they have on tap. So with that said, Jason, the floor is yours.
Thanks a lot, Anthony, and thanks for everyone for joining. Just as a quick refresher, this is a brand new story. We've only been trading for over a year and a half, and none of these projects have been in the public domain for over a decade. And the way we built this very diversified portfolio of assets, we did over 337 desktop reviews, followed by 72 site visits. So these assets were selected for a number of reasons that we will go through today. And just one thing I think we should touch on right away is, as much as exploration companies are in the business of doing systematic scientific exploration to grow the resource, I think it's very important to know that before you allocate a large sum of capital to a bigger drill program, junior companies often forget that as much as we are there to grow the resource, we are also in the business of risk mitigation. And we'll walk you through how we're removing those risks and how we will apply that to our growth strategy today. Just a forward-looking statement, it's on our website. I encourage everyone to take a look at that, as we will be making forward-looking statements. As I mentioned, we're looking at near surface heap leachable ounces in the #1 jurisdiction in the world. And why is that? Is 50% of the reason why mines don't go into production is not because of economics. It's usually because of geopolitical or socio-economical reasons. So if we can remove 50% of the risk in a risky business, we'll take that trade all day to operate in Nevada. 2 is we want to look at near surface heap leachable ounces for 2 reasons. 1 is the CapEx to put them into production is extremely low. And they're least susceptible to inflation in these markets. But most importantly, too, is that the cost per discoverable ounce is extremely low. So shareholders suffer less dilution as we de-risk, drill, and permit these projects. One thing that junior companies forget is that drilling is not a sunk cost, and shareholders need that capital back out. Okay, and as the third largest individual shareholder, I'm very cognizant of that. Today, we're really only going to touch on Wildcat and Mountain View, which are development stage assets. I'll briefly bring up Red Canyon as a refresher. Wildcat Mountain View hosts the 1.2 million ounces of oxide. They took the brunt of the 20,000 meters of drilling. They will have an updated resource early next year and a combined PEA in early next year as well. So each will have its own pit, pads, and ponds, and then you'll truck the loaded carbon from Mountain View to Wildcat to a centralized stripping facility. Red Canyon is a very exciting drill bit story. It's 35 kilometers south of the Cortez complex, sits in the same rocks, sits on the same fault system, same age of intrusive rocks as the Cortez complex, which is over 20 million ounces. In the holes that we put in early last year are some of the best drill holes drilled globally in 2021. Also, our team, we've done this 7 times, put up over 59 million ounces now. Of the 7 times, I think the key metric to that is that 5 of those projects are in construction or production today. The team, very diversified team. We have Ruben Padilla, PhD in magmatic epithermal systems, one of the head geos at BHP and the chief geologist at AngloGold Ashanti. Terry Harbour, PhD in structural geology, also a head geo at AngloGold Ashanti. Mike Leskovic runs a fund, Northfield Capital. Sarah Heston used to run the ASA fund and now is a business professor at Stanford. And Eric Tremblay, who built Canadian Malartic and is the COO of Dalradian. Raphael Duteau is joined about 6 months ago. He is a PhD in geostatistics and resource optimization. We have Jason Banducci, who's done over 7 years of mining investment banking to round out the team from a financial perspective. And myself, I'm a structural geologist. We put the first holes into Côté, which is now the 3rd largest gold mine in Canada. Then I was with the Talisker Group, and we did all the technical due diligence for all of Cisco-related companies before building this company. Quickly, from a share structure perspective, we did raise right before the market went a little sideways. We raised $60 million. We're very lucky to have some of the most supportive institutional shareholders on the street, some of the largest gold-only discretionary funds, very supportive with a total institutional ownership of 65%. As I mentioned, other than Eric, I am the largest individual shareholder. I've put over $650,000 of my own cash in that. I'm 35 years old. If I was Richard Warwick, that's fuel in my jet for a month, but a substantial chunk for myself. And right now, sitting at 178 million shares out. We also have 4 shops with coverage. With buy ratings from basically 50 cents to 90 cents. And feel free to reach out and we'll gladly send you any of those research reports. I think it's very important as we build the next generation of a mining house here that we educate the general public that mining is a key pillar to our society and it can be done in an environmentally and socially sustainable manner. And really educate our generation that the eggs don't come from the fridge, so to speak, because most of the people my age think that. I'm going to get quickly into the assets. Again, if anyone has any technical questions pertaining to economics or low solidation epithermals, I gladly will go into it. Or for the essence of time, I will keep it very high level for today. Right now, the current resource, which is 43101 compliant, we are using a $1,500 pit shell, $2 ton mining, 4 processing, 2 G&A. So these are pit constrained ounces. Right now we're sitting at 776,000 ounces and no strip. And that's one of the key metrics that we will touch on later in the presentation. What were we trying to achieve with this program? It's very important to know that in Nevada, there's 2 types of exploration permits. There's a notice of operations, which gives you 5 acres to disturb. When we took over the projects, there was 4.6 acres already disturbed. So it's limited to how we can grow. Wildcat, for example, is 17,000 acres. And after we've done this detailed mapping program, we've identified multiple magmatic hydrothermal vents that are everywhere else on the property with surface samples that look very prospective. And we're only operating on one vent on 5 acres. So the new permit will come in halfway through 2023. But before we go drill anything else, we want to remove key risks. And what are those? Geotechnical, metallurgy, resource conversion, and the scalability, okay? As you've seen in our recent press releases, the grade continuity and the conversion rate is spectacular. 40 meters of 1.6, 40 meters of 0.9. The resource grade is 0.4. I should also mention, this is the current pit shell that I'm underlining right now. None of these high-grade blocks are in the current resource. Every time we drill down, we keep on extending. This is the oxide pit here in red. We keep on extending the oxide pit below with the mineralization, ending in the bottom of the pit. Today, we put out a batch of holes that were very interesting. One of the things that we do is with our geotechnical holes that hole 10 was designed to do was to test the northern extent of the pit wall to do the geotech. But we also wanted to see, we believed that the mineralization was trending towards the northwest. And sure enough, 50 meters outside of the pit was 42 meters of 0.9 or 0.87. Again, the resource grade is 0.4. And I should just mention that the average grade, not strip adjusted grade, the average grade in Nevada is around 0.35. Another hole that we released today, again, the pit shell of the current resource ends right here, this red line. We just extended the pit another 50 meters that way. So again, what we've done is we've removed the geotech risk. We've shown that, we needed to put holes in between the historical holes so we can see the conversion rate. It's looking very good. The geotech looks great, and we keep on extending mineralization to the northwest and as we go further down in the pit shell. Today's holes, again, 42 meters of 0.87, 50 meters of 0.5, 120 of 0.39. It's important to have significant control over your land package. So the current pit is that little red circle, and that's the only area that has been drilled on this property of 17,000 acres. We've also secured land into the Black Rock Basin for securing access to the highway, accessing water, power, so that the leach pads have a place to go. What will happen is we've already started doing the optimization work. Going to the northwest saves us $40 million in operating costs instead of going to the southeast. We'll be probably using electric haul trucks or conveyors. So the trucks go down loaded, charge the battery, and come back up empty. So everything we can do from an environmental perspective to lower our impact here, okay? Mountain View, we finished drilling in June. Again, $1,500 pit shell, $2 ton mining, 4 processing, 2 G&A. Strip is a little bit higher. I'll get into that, but the grade is substantially higher, 0.57. The resource sits at 427,000 ounces. Again, before we do a bigger drill program and step outside of this 5 acres, we want to remove the key risks, okay? And again, it's the geotech, it's the met, it's the conversion and expansion. There was 27 holes, 7,200 meters. There was never a core hole drilled in this project. So no one understood the fundamental controls of mineralization. And again, low sulfidation, what it's controlled by is this hydrothermal breccia, which grades around 3 to 4 grams. Again, the feeder zones of these are very, very high grade. They could be, almost a meter of 141 grams below the pit. This is very analogous to the sleeper deposit, which has been mined out, but it's around 6 million ounces. Their grade was 0.3 in the pit. Then they went into this hydrothermal breccia, which was around 2 grams, and then into a multi-ounce vein. And we sit at 0.57, we sit at 3 to 4, and the only vein intercept is at 141. So the growth potential and the scalability to these projects is significant, primarily because there was a fundamental lack of understanding on geology. That's where we pride ourselves in creating value, but also is permitting. And these are expensive to permit. Our permits for a plan of operation cost us around $2.5 million. And all that work has been done. The other important thing to know is never been drilled to the west. It's completely open. The sand and gravels, this yellow material and above is, like I said, it's composed of sand and gravel. So it's not a conventional drill and blast. It's a free dig. So you're not looking at $2 a ton mining. You're looking at $1.25, $1.50. Okay. Some of the other holes that we put out, again, 275 of 0.5, 232 of 0.9, 185 of 1.48. The last hole we wanted to, again, extend to test our hypothesis that is this breccia plunging to the northwest, and that's the main fundamental control. And sure enough, 100 meters outside of the pit, 40 meters of 4 grams. Again, just being very systematic on how we show scalability, where it's open, where it's closed off, and do the proper engineering work to create value. Again, significantly, our land package is around 6,000 acres. Again, securing power, roads, water, and we don't like neighbors, okay? So we're only operating on this little circle here of the whole property, and the main control of mineralization is controlled by this frontal range fault. And again, if we want to go into how rift-related epithermals form, I'm gladly will go into greater detail if people have questions. Red Canyon, as I mentioned, is a very exciting drill bit story. Again, pre-resource, very early stage, 12 holes drilled in 2021, 2,300 meters. And like I said, for example, hole 2 was the top 1% of drill holes drilled in 2021 globally. The other ones were in the top 10% globally. So it has all the key signatures to be a world-class deposit like Cortez. But again, only drilled on 5 acres, pre-resource, but everything you look for, major crustal faults, the Wenband Formation, which is the most productive horizon, intrusive rocks that date at 35.5 million years, which is the key window for Carlin-style systems. Everything that you look for these big Carlin systems, this thing checks the box. Most importantly, what really separates us from anyone else in the Great Basin is the grade divided by the strip ratio. What is the strip? Is how much waste do you have to remove to get to your ore? So this gives you your effective grade of the project. And when you do that, Millennial is the highest effective grade in Nevada, okay? For example, Orla just bought GSV, the railroad asset. Their effective grade is 0.19. Their resource grade sits at 0.77, but you have to factor in a 4.1 strip. We're at 1.1. They were bought for $230 million. Their resource was 1.3. Our resource is 1.2. You ask, why are they 230 and we're 30 US or 50 Canadian? Is because they have removed all the risks as we are doing today. And they've been around for 10 years. We've been around for a year and a half, and we will have all those risks removed later this year and early next year. So you're primed for a significant re-rating opportunity. Quickly, I like to say, mining is not easy. That's just the reality. But when you look at it, mining is like any other business in the world, and it just comes down to margin. So at $1,600 gold, the in situ value of that rock is $22. The average operating cost in Nevada is $11. That's a 49% margin at $1,600 gold. So in any gold price environment, these projects make money, and that's why they are so sought after, because it's such a low operating cost and a low capex. Right now, as you may or may not know, the average acquisition cost in Nevada for the ounces is $90 an ounce. AngloGold Ashanti just bought the Rochester mine for $165 an ounce.
Crown and sterling, but yeah, they did pay $165 an ounce, and so in reality, that $90 is actually a bit higher, right? They paid $150 million for 900,000 ounces. Yeah. So you can see what's happened, right? You go through the M&A list of all the activity that's happened globally, and you see that 90% of the M&A in the last year and a half has been in Nevada, and it's due to the scarcity of these projects.
And to ask the question, obviously we want to really focus on strip ratio. So when you look at like the railroad at 4.1 project at 4.1 versus where you guys are at 1.1, I mean, talk about how much of a difference that makes in costs in terms of mining that, because that's a huge difference.
Yeah, you literally have to move 4 times the amount of rock, realistically 4 times the amount of rock to get there, right? The other thing too is that from a permitting perspective, permitting waste rock and permitting things that have a pit lake then triggers an EIS. So you're adding about 2 years to your permitting timeline. So for us, we don't have to permit a waste rock facility. We have no pit lake, so much shorter of a production, closer to production. And when you go through this list, Hasbrook is 50% owned by Sun Valley, so a private equity firm, so that's off the market. Bullfrog gone, Pan gone, Florida Canyon is a big company, Round Mountain is Kinross, Motherlode gone, Railroad gone, Gold Rock gone, and these are bigger to mid-tier companies. So when you look at the list, basically the last man standing, because none of these projects have been in the public domain for over a decade. And in the last 7 years, almost 8 years, they were held in a private equity firm that never even went to site. And here's the value proposition.
Yeah, you look at all that M&A, that's in the last 2 years, and that excludes some of the assets that have traded that the data is not publicly available, right? Like a lot of the Waterton assets have traded, and we don't know what the exact strip is, but what we always say is that there's a chess match going on in Nevada, and the Richard Warks of the world are adding assets. You've got all the majors who are looking to add assets. We met with at a conference the other week. We were meeting with Barrick, AngloGold Ashanti, Kinross. Everybody's looking at available heap leach projects in Nevada. One, because all the easy stuff's been mined out. There's not that many of these left. And so everyone's looking hard at what's available and what has real economics, and what companies have removed those key risks. And as Jason said, by the end of this year and into next year, we'll have shown that we've removed all 4 of those big key risks that are project killers.
And you'll probably kind of be at the same stage as Railroad was when they got bought out.
Pretty much the exact same stage.
Yeah,
exactly. And we'll be securing our water rights later this year as well. You're looking at around 2,000 acre feet of water that we'll be securing.
But
And
the difference is the growth, right? Like railroad, GSV's been around for 10 years. This is our second year in existence. And as Jason said, when the team was looking at originally bringing assets into the company, the most attractive thing about Wildcat and Mountain View is that they're in the number one jurisdiction in the world, but they've never had that exploration plan of operation. So everything that's been done at these two assets has been on a 5-acre postage stamp of the much larger land package. So, GSV is a great comp as far as, the size of the economic resource. But the reality is that, ours, both Wildcat and Mountain View, have a huge amount of potential to grow the resource. So in reality, that's why, it's a bit higher risk to come into the stock now, again, because we haven't proven that out. But this is where you get your, 5-10 times return is once we actually get the permit to grow this thing.
Yeah, and that's why you have the Franklin Templetons and Bestcor and the Van X of the world as 65% shareholders, is because they know we've done this 7 times, and we'll be very pragmatic and execute on what we say we're going to do. And I think it's very important. You go through this list of what we've done, and being a public company for a year and a half. One thing that people also forget is time will kill junior companies. Okay, and in a year and a half, just over a year and a half, we've gone public on 2 exchanges. We've drilled 3 projects, put in 20,000 meters into the ground. Probably the most important thing is built an amazing team that can execute this. We've significantly increased our land package. We've raised, the last raise was for $16.1 million, was done at 40 cents with a half warrant at 55. But since the inception of the company, after acquiring 8 projects, we've also raised almost $40 million in a market where it's, isn't easy to raise that quantum of capital. And what do we have coming up is the network, the plan of operations to show the real growth potential, and also the updated resource and the PEA early next year. With that, again, just to hammer it home, is you got a team that's done this 7 times. It's in literally the number one mining jurisdiction in the world. So it's a key risk remover. You have a resource at 1.2 that'll significantly grow in the coming years. Near surface, no strip, oxide, low capex, low cost per discoverable ounce. Like I said, I'm one of the largest individual shareholders and paid for all my stock. And there's a significant re-rating opportunity, as I mentioned, and as Banducci mentioned, as there's a chess match in Nevada, and the last acquisition went for $165 an ounce, and we're currently trading at 20. With that, gladly open up the floor for any questions.
Yep, thank you. Yeah, thanks, Jason. Kay and Jason, be appreciated. And it's clear that the company, in terms of other companies, exploration companies in Nevada, when you look at the strip ratio and some of those metrics, is clearly the best in class. And at 165 an ounce, for a potential acquisition, I mean, where would that put you at a valuation?
Well, we traded 20, right? So
yes, I mean,
but you can make money pretty quickly at these price levels.
Yeah. And so, in there, like Jason mentioned, they're in the best jurisdiction at a time when, geopolitical climate outside the United States is sketchy in certain areas, to say the least.
Look, right, you read the news yesterday, there's a coup in Burkina Faso, right? There's a lot of mining companies that are coming out saying, our operations are fine, and maybe they are this time, but the reality is when you operate in jurisdictions like that, you open yourself up to risk that you cannot control. And we're not in the business of doing that. And that's why when we put the company together, the focus was in Nevada or in the Great Basin, where, the government doesn't flip every year. There's just again, we're trying to control as much of the risk as we can. And again, from a geopolitical standpoint, we're in the best place in the world. And then, over the next 6 to 12 months, we will systematically remove all of the key risks that face open pit heap leach projects.
Yeah.
Anthony, just for your reference, that puts us at almost $200 million US evaluation.
Exactly. So that's almost 7 times where it is right now, which is pretty amazing. So,
and that's on the base, that's on the 1.2.
That's on the 1.2
that we've got. Again, within this round of drilling up to the updated resource and PEA will show growth. And then once we have the updated permit and can again step out from that little postage stamp that we're operating on right now, we can show significant growth. And again, you apply that $90 to $100 an ounce on a much larger resource and the numbers get a lot bigger.
Yeah. Absolutely. So we're going to wait for a few questions. If you have a question, type it into the Q&A or chat box. We're going to wait for a few questions to be queued up. In the meantime, I wanted to ask you, what comes after the PEA? Like after you, make that announcement, what's the next step?
So the idea, like we were talking is, let me just give an example. So what we wanted to do, this is I guess I can do it on this one, is we wanted to show the economics on this little pit. Okay. Little, it's, it'll be 2.3 by 1.2. It's, we can significantly grow it within that pit. You do 2.3 by 1.2 by 100 meters times 2.5, 2.6 for density. All of that's not going to be mineralization. Say 30% is mineralized. You can potentially push over 200 million tons, and we're at 62 million tons, and that's just in this little pit. Okay. Mm-hmm. So what comes after is again, we wanted to show the conversion rate, the met, the economics, the geotech in the entire property. There's 26 historical little adits in pits. 6 are located in this pit. So after the PEA, we will systematically, drill at 100-meter spacing, all these other little showings that can significantly grow the resource because it's just basically right at surface. So that's really what is next after the PEA.
Great.
And again, I think the key thing is that we're going to show, right? We're going to remove the risk from a geotech perspective. We're going to remove the risk from a met perspective, and show the resource conversion again. So knocking off those 3 project killers and then going to step it out and drilling in the same type of rock, right, outside those pits, so we can use all the information we're gathering right now and that we're going to show in the resource update and PEA, and use that and apply that to basically the step out drilling, right? If you have the same leach kinetics in the pit, same rock, and if you step out, you're going to be able to apply that, right? It's what we can do is actually it's going to be pretty phenomenal because again, the type of deposits that we're looking at, very homogeneous, and you can extrapolate as long as you can tick off those key risks. Yeah,
absolutely. We had a question that just came in. How long can the recent raise carry the company, and will it produce drill results for a potential bid on the company, in your opinion?
So next year, the biggest thing that we will be doing is all the detailed engineering for the actual mining permits. Okay, so by the end of next year, we will have all the detailed engineering, and that will cost around $7 million. And we'll have all the detailed engineering submitted to the BLM, and they submit it to NEPA. And how you get, $90 or $165 an ounce is as soon as those ounces are into the NEPA pipeline, that's where you gap up. So depending on how much engineering we have to do for the permit, we have a general idea. That's where the 7 million is. But as we do things, it can change. So right now, a long-winded answer is end of Q2, Q3 of next year. And again, dependent on when we drill the geotech holes for the leach pad and stuff like that.
And, let's say, I don't think it'll be the case, but let's say capital markets are still struggling at that point and you need to raise, let's say $15 million, whatever it may be. Do you have alternatives to go after that money that are outside of diluting the stock?
Yeah, thanks for bringing that up again, Anthony. Yeah, what we can do right now on a PNAP basis, on a consensus using what the analysts have out there, we're trading at, I believe, 0.18. Royalty companies will give you money at 0.6, 0.7. So you'll take that arbitrage all day, and a 1% royalty is, about 3 to 4% NAV dilution. Adds about $10-15 to your ASIC, but can generate you, anywhere from 15 to 20 US dollars. So, when you dilute it on an equity basis, 30% or 3% on a NAV basis, it's much more creative to do the royalty than to do the equity. And I always hate when people say, "Oh, royalties are non-dilutive." Well, the reality is everything is dilutive.
Yeah,
it's just on a NAV basis or on an equity basis. Pick your poison, really.
Yep, absolutely. This was an add-on to the last question. Can you detail any permitting issues and when you will get them in your estimate, or when you will get your permits in your estimate? Are there any issues right now with permitting?
In Nevada, it's pretty simple. You got to do your cultural, your biological, and all like the grass species and stuff like that. All that is already done. There was no issues with that. So for the exploration plan of operations, like I said, all the baseline environmental assessment work has been done. And that we should have the exploration plan by middle to late of 23. To get the mining plan of operations, we will have to do more baseline work next year. We'll have to do the engineering, and by the end of 2023, early 2024, we will submit that project description to the BLM and to NEPA. Under Trump, NEPA had a year. Biden has removed that, but now there is talks of putting that back in. So basically, by say the beginning of 2024, you could be a year to maybe a year and a half, 2 years. It's in the government agency's hands, but usually it's around a year to 2 years. And why it's so quick is, as I mentioned, this is a great image. Is basically we're just scooping the top of this hill off, and this is the basin down here, and then conveying it or hauling it down to the basin. So this is literally, you're walking on ore right here. So you can see there's no strip, there's no vegetation, there's no one around, and there's no pit lake. And what I mean by pit lake is, does the pit intersect the water table? And that requires another level of permitting, and that requires an EIS. In that, the pit lakes add about a year to 2 years to your permit. So, for example, Mountain View will have a pit lake, but in our mine sequencing, Mountain View comes on in year 3 to keep that steady state of production.
Great, thank you. I think one of the most important things to talk about is the low CapEx. I think we deal with a lot of mining companies here at Torrey Hills Capital, and some of these mines are $500 million to get up and running. Talk about the CapEx. I mean, this is gold that's easy to get to. So your CapEx would be a fraction of that, correct?
Yeah, we're going through all these numbers right now and doing the optimization work. GSV, their CapEx, mind you, they have a lot of waste rock facilities and all that sort of stuff. Their CapEx was 190. For example, Minera Alamos just put their PEA out today. You're looking at the same tonnage, no strip, and their CapEx was 30 million.
Wow.
So I'm not saying we're going to be 30. I'm not saying we're going to be 190. The reality is we're going to probably be in the middle.
Right. Which is still, I think, reasonable for.
Yeah. And the reason why junior companies never re-rate, right, is because, you're $100 million company with $500 million or $1 billion CapEx sitting on your head. So you're never going to get that re-rating optionality. But when the CapEx is 100, even if it's 150, and you're, a $70 million or $100 million company, you do have that re-rating potential.
Yeah, absolutely.
And the reality is, right, it's the best jurisdiction in the world with growth potential. This would be a very, very easy project for project financing.
Yeah. And to your point, I mean, I think it's really important to drive home too, that, the resources around the properties, in terms of like labor and roads and water. I mean, none of this stuff has to be, you don't really have to worry about any of those things because it's all there. And that's, I think, one of the benefits of mining in Nevada, of course.
Yeah, you look at a lot of projects around the world, and whether it's in the Andes and you got to have access to a desalination plant, or whether it's in BC and there's a glacier and there's salmon spawning streams and rivers everywhere, and you got to ship out a concentrate down a river, like all that stuff. There's great projects globally. Don't get me wrong, but like dealing with that stuff from a permitting perspective it's a lot. Okay. And that's why, like I said at the beginning of the presentation, 50% of why mines are going to production is because of those reasons. So if you can remove 50% of your risk, you'll make that trade all day.
Yeah, absolutely. Don't have to worry about any of that stuff in Nevada, which is fantastic.
It might take a bit longer, but at least we know there is a process set out, and we're working through that process. And again, we haven't really talked about it too much, but in decisions we make every day in advancing the company, we are moving the company forward, assuming that we are going to be the ones to build and operate a real mining company, with our first assets coming online being Wildcat and Mountain View, right? So we're, look, if someone wants to come show us $200 an ounce, then, as Jason always says, we're in the business of making money and we're happy to hand over the keys. But, everything we do when it comes to, de-risking the process, advancing all the permitting, everything we do is we assume that we're going to be the ones putting these assets into production. And so, if it takes a bit more time, if it takes a bit more work, we're not rushing it. We're making sure we're doing all the right work, because we may be the ones who build these things, and we'd love to be, right?
Yep, absolutely. While you're on that slide, Jason, can you talk about Waterton's position? Because I know that they're slowly exiting. Just what's the timetable for that?
Yeah, so their last block comes out November 3rd. The reality is that we have been very cognizant of the release dates, and we will place that block as soon as it's removed, and remove them off the share register.
So they will no longer have any shares in the company.
Right.
You there, Jason?
No, exactly. We've got a successful track record of doing so. The last block we moved over to Franklin Templeton. The first block we had existing shareholders and a high net worth investor take it. So we've worked very well with Waterton. They've been great to deal with. But the reality is they're closing that fund down. So they're in the business of returning capital to shareholders. And we've worked with them to place the last 2 blocks, and we'll successfully place the final 7.5% of the company before the end of the year.
Yeah, so that's next month, right?
Yeah, and I think people, to be very honest and transparent, people see that as an artificial overhang. Okay, I think that's what people are cognizant of, and people know that. Okay, but again, as Banducci mentioned, we placed those blocks right away, and they will be off November 3rd, and then we have a series of major catalysts that'll get you up to that railroad GSV level in the next kind of year, basically.
Yeah, maybe even sooner than that. I mean, if we can get the re-rating within, maybe 6 months or 2 quarters, right? So maybe end of Q1, you think possibly?
We're controlling what we can control, right?
I know. Yeah. I don't like to put you guys on the spot like that, but I just want our viewers to understand that there are a lot of catalysts coming up. There is an opportunity for a re-rating here in 2023. Some of these exploration companies have been, their stock prices have really been pushed down here at these levels, and many of them, most of them, are not as well capitalized as Millennial right now. And so
that's one again, and we're only realistically, you only see value in the market reflected on Wildcat and Mountain View, maybe a little bit of Red Canyon. But we've got a full portfolio, right? We've got 8 assets, 7 in Nevada, 1 in Arizona. We've got a lot of optionality, and we see that 4, 5, 6 times return based on just Wildcat and Mountain View. The rest you get for free.
Yeah, absolutely. And so there's a lot of value here. And we're really impressed with what management has done in a very, very short period of time. It's only been about 1.5 years. And it's Jason mentioned all the things that they've done in that period of time. So it's really worth a look here and putting it in the portfolio and just in taking a long-term position in it, because we do feel that the stock is way undervalued compared to its peers. So with that, I think we're going to wrap it up here. I want to thank Jason Banducci and Jason Kosec for coming on today and giving our viewers an update on Millennial Precious Metals. Obviously, a lot of exciting things are happening with the company. 2023 should be a pivotal year. And so before we wrap it up, Jason, I'm going to throw it over to you with any parting words for our viewers.
Yeah, I think one thing, we all think gold's going to go. And the way to look at things is that, obviously management team, location, and quality of the assets. The other thing too is the cash position. I got to double check this fact, but a very reputable person was telling me that of the over 16, there's around 1,600 junior companies on the venture, real companies, about 58 to 60% of them have under $2 million. Okay. So even when the market does turn, those guys are going to hit the equity markets as fast as possible because they have no capital. So the ability to re-rate when you have a financing overhang is going to be very difficult. So that's one of the key things that you should always look at, is making sure you have enough cash to weather this period out and pick up things that are at a discount now, so that when it does turn, there's no need for an equity financing.
Yeah, and I agree. There are a lot of companies out there that are going to be looking for equity when when the market turns, which is a really good point. And then I also want to mention to our viewers again, Jason, mentioned it earlier, that this is a management team that has put their money where their mouth is. They've taken a huge position in the stock, and they've taken it at levels higher than where we're trading at now. So you have an opportunity to get involved in a company with a lower cost basis than a management team has. So if it was good enough for them to buy higher than these levels, then I think it's definitely worth a look down here. So keep that.
We're in for 25 cents all the way to 66. We were both, Jason and I were buying last spring. Yeah.
Which, I just feel like that's a really important point because of where the stock is trading right now. So with that, we're going to wrap it up. Today's code word is gold, GOLD, for the for feedback purposes. In the meantime, if you need any additional information on Millennial Precious Metals, you can visit the company's website, millennialpreciousmetals.com, where you can get details of the company's current projects and latest press releases. I want to thank our attendees for taking the time today to join us. I look forward to your feedback. I will be sending out feedback in the next few minutes. So your timely feedback is very important to us, and it's greatly appreciated. So with that, we're going to wrap it up. Thanks again, Jason Kosec and Jason Banducci, for coming on. And we will talk to you soon. Thank you.
Cheers. Thank you very much, everyone.
Yeah.
Thanks.